All right, and we are back for another show. So, billionaire real estate investor Tom Barrack, he's done a number of interviews in the last week or two on CNBC, on Bloomberg, warning about a looming real estate crisis with commercial real estate and other parts of the real estate market, with defaults on mortgages if there's not more government intervention. I believe the Congress bailouts, there was not a full blanket bailout for a lot of the mortgage finance industry. I've been compiling a number of stories for the last week or two about what has been going on, and honestly, I've been seeing this a lot lately. The more I learn from contacts and articles of different subdivisions of the financial industry, from either blog articles they put out or speaking to sources behind the scenes, whether it's contacts that are good friends with bond portfolio managers or people in the mortgage finance industry or hedge funds, the more I find out about what really happened in the last 3 or 4 weeks, the more convinced I am that basically everything broke in the last 3 or 4 weeks, even worse than 2008. But the Fed and the other central banks were able to print and create even more bailout programs, roll them out even faster. So we have an article, it's not on your screen yet, I'll integrate it, don't worry about it, with Christopher Whalen. I've interviewed him on the past in my channel. He is a very good banking analyst. He also covers the mortgage finance industry. So he was warning about the 2008 housing crisis way before. He got a lot of cred that way. He's very well respected on Wall Street, a really smart guy. And on his free blog website, which is theinstitutionalriskanalyst.com, he's been putting out a number of articles in the last couple weeks, including the one I want to talk about on March 22nd, What Must Be Done to Support Housing Finance. So he was speaking with his contacts who trade mortgage derivatives, all different parts of the mortgage finance industry. It's a $12 trillion marketplace of mortgage finance, according to Christopher Whalen. Liquidity was rapidly disappearing. This was the week of March 22nd, so this was not too long ago. Banks and even government-sponsored enterprises, which is Fannie Mae and Freddie Mac, are said to be backing away from the mortgage markets with potentially disastrous results. And as one dealer who spoke to him noted on Friday, the specified pool market is dead. There is no speculative bids anymore, so it went no bid. The Fed action that was done when the day before the blog article came out, no buyers in the market, according to the source that Christopher Whalen spoke to. And he has extensive mortgage finance industry contacts. He knows a lot of the people he goes to all those mortgage-backed security conferences, the banking conferences. He studies the balance sheets of the banks. He has a bank dead pool list that I've talked about in the past. So he has extensive contacts in this industry. So there has been a widening, according to him, of the primary rate for swaps and treasuries. Another veteran of the mortgage manager who trades these mortgage-backed securities and other mortgage finance derivatives told him that, quote, you need to get the federal government to buy $1 trillion of agency debt now. They need to suspend the Volcker rule. Banks are our only chance to not go into a depression. They have to fix the system to let banks add liquidity. But the banks were also having problems, as I've covered from the information I was given by someone who is upper-level management at one of the credit ratings agencies, that the banks were also having enormous problems. U.S. banks, their bond portfolios of investment-grade corporate bonds and high-yield corporate bonds, these banks own a lot of these, often with trading with leverage and using stupid value-at-risk models, which went bad in 2008. These banks, their bond portfolios were rapidly declining in value. And I reported that my contact told me, who is good friends with a bond fund manager inside one of the investment banks, that he was ordered by his bosses and his risk officer to basically sell everything as fast as he could. And it was a similar story for all these bond portfolios at the investment banks. So the banks were not in a good position. Plus, you have all the corporations that were massively drawing down on their revolving credit facilities. So the banks got slammed as well in the last couple weeks. Those are the American banks that the worst problem, I was told by my contact inside the ratings agency for the American banks, was their bond portfolios for investment grade bonds and high yield was collapsing rapidly. And everyone wanted to go to the exits on those. There was no bid. And then you also had hedge funds that were blowing up with the risk parity trading strategy, which is use a lot of leverage. Often that leverage was borrowed in the repo market. Money markets loaned into the repo market. Didn't know that hedge funds were leveraging up massively with borrowing from repo to go and do risk parity, leveraging the money they borrowed from the capital they borrowed from repo, the currency they borrowed from repo, and then going and leveraging up 10x or more for treasury trades or corporate bonds, investment grade corporate bonds or high yield or other. And those blew up too. So you had a lot of things blowing up in a very short amount of time. And the source continues here. Get the mortgage market working again. ABS is totally shut down. The double lines of the world are panicking. So even double line Jeff Gunlock was panicking. He put out tweets about this. This is worse than 2008 for the system, according to the source that Christopher Whalen spoke to. If they don't act soon, we are in real trouble. So liquidity drying up in the short-term mortgage financing market for loans, mortgage-backed securities, servicing advances. There are no bids. This was March 22nd. For specified pools in either the government or conventional markets, primary dealers reportedly are forcing real estate investment trusts. And I'm getting a lot of people asking me if it's smart to go and buy real estate investment trusts, looking for those juicy dividend yields. First things first, you got to look at the dividend payout ratios. You got to see how high those are. But each individual real estate investment trust, it really depends, because some of these real estate investment trusts, you have to study the business model. What some of them did was they leveraged up their balance sheets enormously, and they were buying some agency debt, some Fannie or some mortgage-backed securities or mortgages from Fannie Mae and Freddie Mac. But other ones took a lot more risk than that. The key here is the leverage. They use a lot of leverage on their balance sheet. And if those assets that they bought, if they're declining in value, because if you have the problems with the leverage and then the assets are falling in value, it's a double whammy. So if you're going to, this is just my opinion, if you're going to buy some of these real estate investment trusts, you really have to do some work, unless of course you're expecting a bailout. But then we don't know what terms each bailout's going to be. Not everyone's going to get the same bailout. Not everyone might even get a bailout at all. It could be winners and losers. Tom Barrack at Colony Capital, because he's a billionaire and friends with President Trump, his firm might get a bailout. Another firm, another competitor might not. This is what happened with Lehman Brothers and some of the other banks in 2008. Not everyone got the same bailout. Not everyone got the same type of bailout. Not everyone got the same size of bailout. Lehman Brothers was sacrificed. AIG's bailout was different than General Motors and the banks and Bear Stearns and Merrill Lynch and some of the other bailouts. So not everyone gets the same type of bailout. Like, just as just my opinion, my educated guess, I'm pretty confident that Boeing's going to get a much larger bailout now than anyone else. Because from what I've been hearing here in DC, that the Republicans, who are mostly, all they're all connected to the lobbyists from the military-industrial complex and Boeing. All the Republicans in Congress and even a good amount of the Democrats are all trying to make sure that Boeing is well taken care of. Now, we don't know if you go out and buy Boeing shares, and I wouldn't do that in my opinion. We don't know what price the bailout would be at. So if you go out and buy Boeing shares, you don't know what the price of the Boeing bailout's going to be. If the shareholders are going to get wiped, you don't know. But from what I've been told from the sources here, that the congressman, the priority one for bailing out of companies is Boeing. Okay, back to the article here. Primary dealers reportedly are forcing real estate investment trusts, which people need to be very careful. You have to go into the real estate investment trust and look at the assets. What do they own? How much leverage were they bought with? You have to look at those types of things. What's the dividend payout ratio? Because if the dividends are drastically cut, the stock could crash even more. And other levered investors to liquidate mortgage-backed security positions. Wow, I got to reread this. Primary dealers reportedly forced real estate investment trusts and other leveraged investors, so this includes hedge funds, to liquidate mortgage-backed security positions. George Gammon needs to take a look at this, adding further pressure to the markets. So this was only, 2 weeks ago? That primary dealer banks ordered real estate investment trusts and hedge funds to liquidate mortgage-backed security positions, adding further pressure to the markets. So they got margin calls. Prior to the crisis, 20% of the government, FHA, VA, USDA loan market was financed in specified pools. Also, the lack of specified pool market in conventional and government loans hurts the low-income borrowers that pay the highest fees and need the need help the most. The large banks and government-sponsored enterprises, which if you are not American or not familiar, it's Fannie Mae and Freddie Mac, which had enormous problems prior to and during the 2008 financial crisis, which was mostly on real estate and derivatives attached to real estate, like mortgage-backed securities, subprime mortgage, and in credit default swaps. Our credit default swaps were not just on home builders or banks, but it was mostly mortgage. The largest amount of derivatives were mortgage-backed securities. Stepping back from the mortgage-backed security market and are withdrawing financing, also ninja loans, no income, no job, no assets, withdrawing financing from warehouse and advanced lines, putting further pressure on independent mortgage banks. Fannie Mae and Freddie Mac reportedly are stepping away from bidding on specified pools in the conventional market. Wow. So we had, in the last couple weeks, we had things get so bad that even Fannie Mae and Freddie Mac wouldn't buy. Wow. That's unbelievable. Because they're backed by the U.S. government. There's people that saying that they should be 100% nationalized now, and then all these mortgages should just be absorbed by Fannie and Freddie. I've read that. I can't remember which article. I have a bunch of articles open right now. I'm not going to read all of them. The Trump administration is wasting what could be a valuable liquidity tool by not using the government-sponsored enterprises, Fannie and Freddie, including the FHLBs, to provide liquidity to the markets in tandem with the Federal Reserve. What must be done to avert a liquidity crisis in the housing market? First, the Federal Reserve and other agencies must increase their support of the housing market. Specifically, the Fed needs to increase its purchases of mortgage-backed securities to alleviate strong selling pressure across the market. The Fed did increase its mortgage-backed securities. That was added to, I think, QE5, open-ended QE. At a zero to last week's daily allocations by the New York Fed, single biggest thing the Fed can do to help the market is to announce big mortgage-backed security purchase numbers and keep buying until yields start to fall. The street is extremely fragile. So 2 weeks ago, Wall Street was extremely fragile. Commercial banks and IMBs, investment banks, I guess, hoarding cash. The Fed in the government market and GSEs in conventional loan market should bid directly for specified pools, again until mortgage-backed security yields start to fall, and especially for discount coupons. So I have more. There's a lot more here. A lot more. Let me skip around, and I'll move to the article on your screen that came out from Politico on March 27th. Let me take a quick water break. Okay, next financial crisis, a collapse of the mortgage system. The mortgage finance system could collapse if the Fed doesn't step in with emergency loans to offset a coming wave of missed payments from borrowers crippled by the global pandemic. Well, actually, I put coronavirus in the title, so what does it matter? I put coronavirus fallout in the title. The U.S. mortgage finance system could collapse if the Federal Reserve doesn't step in with emergency loans to offset a coming wave of missed payments from borrowers crippled by the coronavirus pandemic. Congress did not include, according to this article, at least by Katie O'Donnell from Politico, Congress did not include relief for the mortgage industry in its $2 trillion rescue package, even as lawmakers required mortgage companies to allow homeowners up to a year's delay in making payments on federally backed loans. When individuals stop making payments on their home mortgages, the companies that handle the loans and process those payments, the so-called mortgage servicers, all are still on the hook. They're legally obligated to keep sending money to insurers and investors in mortgage-backed securities. Someone was actually wondering if Berkshire Hathaway is gonna get absolutely clobbered with this. I think there's some research work to do there on problems for the reinsurance market, insurers and reinsurers, and Warren Buffett's Berkshire Hathaway is super heavily involved in the reinsurance market, meaning that they reinsure a lot of insurance companies, banks, etc. Okay, investors' mortgage-backed securities, the giant bundles of home loans that are packaged and sold on the securities markets. Now, industry executives and regulators are worried that Congress's generosity toward homeowners could wipe out those companies, causing investors not to get paid and potentially bankrupting the entire mortgage finance system. Welcome to dystopia. If it's not one thing, it's something else. These last 3 or 4 weeks have been crazy. Another day, another bailout, and then of course the new one, the new little funny quip I just came up with is Fast and Furious rules changes. A domino effect that would make it much harder for borrowers. Fast and Furious rules changes, as in they're not going to force people to make the rent payments immediately. They're going to delay some people with the mortgage payments, so not everyone collapses all at once, because then if that real estate hits the market, there's obviously not a lot of buyers right now. A domino effect that would make it much harder for borrowers to access credit to buy homes. Housing lobbyists sounded the alarm to Senate staff about the potential danger, but the sheer scale of the rescue bill and the focus on communicating the industry's other big concerns, such as the details of how long mortgages would be suspended, meant their warnings were unheeded in the rush to finish the massive legislation. Yet while the final bill allocates $454 billion for the Treasury Department to support the Federal Reserve's emergency lending programs, including for large corporations, there is no overt requirement for lending to mortgage companies, despite a week-long lobbying push by the industry. That's surprising that in spite of lobbying, they couldn't get any money. Probably because it's really tough to set up those parties with cocaine and hookers. Okay, that's a joke. Well, kind of. Quote, there was a strong desire on the part of housing lobbyists to have the bill explicitly direct the Fed and Treasury to use some of that money to finance servicing advances, said Michael Bright, CEO of Structured Finance Association, which represents 370 financial institutions in the bond market. Now, industry lobbyists are turning their efforts to Trump administration officials. Quote, we have been in constant contact with many parts of the administration to ensure that they understand the urgency of this liquidity facility being set up. This is another emergency liquidity facility, another bailout facility, said Bob Broke-Smith, another bailout facility besides Fannie and Freddie, because the government could just stick a lot of this stuff into Fannie and Freddie. President and CEO of the Mortgage Bankers Association, a trade group, on Thursday, Treasury Secretary Steve Mnuchin said the Financial Stability Oversight Council, a powerful intra-agency body that consists of the top financial regulators, is, quote, particularly focused on the liquidity issues that market may have. Mnuchin said he was establishing a task force to report back on the council on the matter on Monday. Concerns about liquidity in the mortgage finance system have been building for years, and I would say the dam broke based on what I just read with Christopher Whalen around the end of March, mid to end of March. Concerns about liquidity in the mortgage finance system have been building for years as the companies that service mortgage loans are increasingly non-banks, which don't have banks access to Fed loans or their strict capital requirements and deposits to fall back on. Banks, which once dominated the business, have steadily pulled back since the 2008 housing market meltdown. Usually, a mortgage company can withstand a few borrowers failing to make payments, but the breadth of the coronavirus pandemic has sparked industry estimates of between 25 and 50% of borrowers being unable to pay. I saw another article when I was doing research for this that in New York City, it's estimated that at least 40% of businesses in New York City can't make rent payments. That was like this week. That, quote, could threaten the ability of a mortgage servicer, particularly non-bank servicers, to remain a going concern, the Conference of State Bank Supervisors warned Fed Chair Jerome Powell and Mnuchin in a March 25th letter. State regulators wanted to weigh in because, quote, our members are the primary regulators of the non-bank services, said Margaret Liu, CSBS Senior Vice President and Deputy General Counsel. Wow, this is a long article. If 25% of borrowers fail to make their mortgage payments, the industry would need $40 billion to cover 3 months of payments, according to Jay Bray, CEO of servicing company Mr. Cooper. Depending on how long the situation lasts, Broke-Schmidt said demands on mortgage servicers, quote, could exceed $75 billion and climb well above $100 billion. And if mortgage companies fail across the board, the system breaks down, said Jacob Jakubowicz, Vice President, I think I got that all right, for policy development at Enterprise Community Partners, an affordable housing nonprofit. Quote, the kinds of relief we did during the foreclosure crisis of 2008, all of that had to do with the fact that we wanted to ensure that investors from across the world would continue to treat U.S. mortgage-backed securities as an incredibly safe investment, Jakubowicz said. Oh my God, there's going to be people laughing about that one. Quote, that would have very serious ramifications for the availability and price of mortgage credit. Bright, who formerly managed the $2 trillion portfolio of government... I can laugh at my mistakes. I am very humble. Bright, who formerly managed the $2 trillion portfolio of government-run mortgage financier Ginnie Mae. I'm having a real tough time now keeping a straight face. $2 trillion portfolio of government-run mortgage financier Ginnie Mae said he believes the Fed will come through with an emergency lending program for the industry. Because why not? How many alphabet soup bailout programs are there already? There's at least half a dozen. There's money markets, there's primary dealers, there's commercial paper, there's the Fed lending directly to corporations, there's uncapped QE, there's currency swap lines. I probably missed a couple of them. Who cares? There's at least half a dozen. In many, many trillions. Even though that language wasn't included in the Senate bill, I do think it's likely that this could be part of the Fed's term asset-backed loan facility. Oh, that was the other one. Fed's term asset-backed loan facility program in the end, he said. Federal Housing Finance Agency Director Mark Calabria, who regulates Fannie Mae and Freddie Mac, the two government-sponsored mortgage giants that prop up about half of the nation's $11 trillion market, said this week in a Bloomberg TV interview he was confident that large banks would continue to extend credit to mortgage servicers for the time being. Still, he said, quote, if we get to a situation where this goes longer than 2 months, absolutely there's going to need to be a bigger solution, as in a bailout. I just added that part. Brooksmith said some mortgage companies won't make it that long, depending on the share of loans in their portfolios located in areas of the country where the virus has hit particularly hard, like New York City or Seattle. There's obviously going to be a New Orleans. There's going to be a lot more hotspots coming. I was just listening to the President Trump conference for a little bit, and it sounds like there's a lot of other cities that are starting to get ramped up here. Quote, some servicers will need the liquidity sooner than others, so we're hoping that the facility will be set up immediately, Brooksmith said. The article continues. This article is long. It's in-depth. It's a good article. Lou also said the credit lines from banks wouldn't be enough to keep the system afloat. Quote, the mortgage market is one of the many multiple complexly interconnected pieces of our financial system, so those assurances are really important, but I think the role of the government in being a reliable and available source of credit for the mortgage market and mortgage servicers during a crisis is even more important, she said. In the meantime, the industry is crossing its fingers that the individual cash relief in the Senate bill will lead to fewer people needing to request forbearance on their payments. That's clearly not happening with a lot of the restaurants. A lot of these restaurants I have stories out are declaring force majeure. And force majeure, whether it's an oil or energy contract or a restaurant that can't make rent payments, it's really bad for the counterparty. Really, really bad. Because in commercial real estate, a lot of those people holding the mortgages are probably doing it with leverage too. In the meantime, the industry crossing forbearance on their payments. Quote, we're hoping that the take-up rate won't be too high and that the duration is not extended, but we have to prepare for both. So I have a number of other articles. I'm not going to read them all from the last week or two. Coronavirus poses a new threat to mortgage industry from the Hill, Sylvan Lane. Coronavirus, the U.S. is bracing for the biggest wave of mortgage delinquencies in history as the shadow of 2008 looms. That came out earlier today from Shubham Ghosh. And let's see here. New York Times, mortgage lenders consider plan to suspend payments amid crisis. The CARES Act loan forbearance program could negatively impact mortgage industry by Bethany Blankley of the Center Square. And then I have a number of articles here about retailers, whether it's U.S. retailers or restaurants in shopping malls, strip malls, that can't pay the rent. That are going to like Mattress Firm, Subway, Cheesecake Factory I already talked about as soon as that came out. Wendy's, franchise owners at Wendy's, I guess, can't make payments to the parent company. Dunkin' Donuts is easing royalty payments. I have another extensive article on that. That Cheesecake Factory, Subway, other major retailers tell landlords they can't pay April rent due to the coronavirus. From Sarah Painter at Yahoo Finance on March 26th. And then I have one from Adweek here from yesterday with rent due. Leases don't give retailers and restaurants an easy out. The chains are hoping for some form of government assistance that provides financial relief, but I think the problem is that the larger restaurant chains are not included in the Congress bailouts. Some retailers and restaurant chains are invoking the, quote, force majeure clause in the lease agreements to withhold rent. Remember, that also occurred with oil and natural gas companies, especially natural gas and LNG. Most agreements between tenants and their landlords involve some form of rent deferral. Some retailers may have the dim view that potential litigation would get tied up in the court system for years. And it looks like the large restaurant chains are not going to get the bailout help that they thought. Crazy stuff. Okay, we have a super chat from J6. Thank you very much. I appreciate it. A super chat from Steve Gerard. Thank you very much. Steve asks, hey Jason, with gold and silver mines closing, do you see the real prices skyrocketing this week or next? Do you see the collapse of the paper markets this week? That is tough to say because, again, it's all about the rules changes, and the COMEX and the LBMA are changing the rules like crazy, whether it's margin requirements, delivery requirements, what they're considering good bars for delivery now. You know, they're just changing the rules. So I could see a situation where the dislocation, the divergence between the paper futures markets and the physical markets with premiums to actually get an ounce of gold or an ounce of silver actually get worse. So I can't tell you for sure when the paper markets will collapse. I could just tell you that the probability is very high the divergence will get worse. And the people in power, whether that's COMEX or LBMA, they're trying to make it very, very hard for people to get delivery of physical metal. They're trying to dissuade people. There was a propaganda article, it was spun very heavily, where the title of the article and most of the paragraphs in the article that came out about the gold market were that there's plenty of actual gold available for delivery. That's, I think, to paraphrase, I think that's what the article title said. But meanwhile, buried in the article, it said a record amount of people stood for delivery on the futures contracts and took a record amount of physical delivery of gold. So they spent, the headline was spin and bullshit and propaganda. Most of the article was spin and bullshit and propaganda. And then buried in the article was like 1 or 2 sentences of truth. This is what you're up against. I think the rules changes, they're going to try more and more rules changes. But my friend James Anderson, he's probably listening from SD Bullion. What he was saying is this is very similar to the London gold pool breaking. So we're seeing a lot of similarities to how the London gold pool broke. The London gold pool, they were manipulating the gold price. I believe they were running propaganda in newspapers telling people not to buy gold back then. I've seen a few of the ads. And eventually the London gold pool broke, and then the dam broke, and the price in gold and silver went crazy. Before they were able to blame the problems on the Hunt brothers and change the rules and screw the Hunt brothers over. But there was a big, big run on gold and silver. So we're in that process where, like the manage retreat, they can't manage retreat at the same games and at the same pace that they've done in the past. And I think they realize the dam is about to break, very similar to what happened to the London gold pool. So shout out to James Anderson. Thanks for bringing that up in a video. I did watch it. Thank you for the super chat, Sean. Sean, are you a Patreon account contributor? You put a lot of super chat tips in here. You can get all the content behind the paywall for $5 a month. I do have over 600 patrons now. It's almost 700, actually. It's growing very, very rapidly. A lot of people taking a look behind the paywall. There's a lot of audio podcasts, a lot of well-researched articles about companies in different industries, and some a good amount of technical analysis charts too. Some of the articles actually have all those things in one. There's articles lately on the cost for the silver miners, on the oil market demand, how the contango trade. Oh man, I think there's too many people piling into the contango trade. Imagine if you had bought paper oil futures contracts like at a higher oil price. You're getting crazy amounts of margin calls now. But the storage amount for oil, oh boy. The demand for oil is still collapsing. The estimates, I'm seeing a lot of estimates out there that oil demand could collapse maybe up to 20 million barrels per day. But we don't know how long this is going to last. Maybe it gets even worse than that. Meanwhile, the storage facilities for oil, all these oil producers, whether it's the Saudis, OPEC, Russia, the U.S. shale oil producers, there was a 4-year record for a crude oil inventory build here in the U.S. So that's a sign that the U.S. shale oil producers are not cutting back on oil production yet. Ugh, what a mess. Okay, and then I have another article here. What happens if you can't pay rent on April 1st because the coronavirus forced you out of work? So I have a number of other articles here to take a look at in the information and description section after this video is over. I've been talking for about 30 minutes. It's getting late. Probably want to go lift some weights. Again, be very careful with real estate investment trusts. They're going to be different. You don't know. You have to look at what assets the real estate investment trust owns. This is just my opinion. You have to look at what assets the real estate investment trust owns. You have to look at cash on the balance sheet. You have to look at how much debt the real estate investment trust was using to buy the assets. Some of them use a lot more assets and a lot more leverage than others to buy the assets. And then you have to maybe go in there individually and see what the real estate investment trusts are buying, because not all the stuff is in good shape. Some of these real estate investment trusts own really, really bad paper right now. Okay, everyone, thank you very much for listening. My voice is starting to go. There will be more content, research, information, financial analysis, and education to come. There are so many topics to cover that have happened in just the last 3 or 4 weeks. I have enough topics here. I'd say that I have enough topics probably for at least a couple months. So it will be slowly coming out. It's just me here. I don't have a research staff. I don't have an army of people helping me make videos. So if I did that, I could probably get up to a couple videos a day. But as of right now, it's just me. But things are growing very rapidly here with my tiny little business, so that's good. Good news here. So in spite of all the craziness going on, my business is actually doing pretty good. Oh, I just want to thank all my Patreon account contributors. So if you're chipping in $5 a month, $10, $15, $20 a month, it's amazing. Thank you very much to my monthly PayPal contributors, and people tip me once in a while. I also take cryptocurrency donations if anyone still owns any. If anyone's still hodling, while those things are just clobbered more. Oh wow, I only got 100 likes on almost 500 people watching. That's pretty bad. Well, I guess I focus on the content. Oh well. Okay, everyone. Have a great weekend.